Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, and more, including smaller deals that you can do without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. DealQuest community, I'm so excited to introduce you to a remastered episode of the DealQuest Podcast. So, the podcast has grown so much. We started it about 5 years ago now, at least at the point I'm recording this. And we, in the beginning, had maybe 60 or 80 listeners per episode. We now have many multiples of that. In fact, we've got about almost 100 times that number. And I realized that there were so many great interviews I did early on in the podcast. In fact, in the first year of the podcast, it wasn't even called DealQuest. It was called Fueling Deals until we rebranded it. And we interviewed some amazing entrepreneurs and deal makers and just amazing stories, amazing content. And I know that so many of our listeners have joined us over the last several years and may not have heard some of those earlier episodes from 5 years ago, 4 years ago, even 3 years ago. So we have picked the best of those old episodes, and the advice and the stories and the experiences are timeless. So we've remastered them, made sure the audio is great, and put in our new intro and outro and that kind of stuff. And we're going to be re-releasing some of these amazing episodes. So look out for them from time to time. And here's one coming up right now. This episode is a solo cast, so it will just be me. And what I wanted to do on this episode is to give you an overview of the various types of deals and also to define some terms that people get confused. So this is just intended to get you all thinking about the various types of deals that you can do. So if you're not doing deals yet, and you may have a limited conception of what deals are, this is going to open up your mind. And even if you're doing certain types of deals, this may give you some ideas on what some other types of deals that you can do. Again, no matter how big, small your company is, whichever stage of growth or length of time you've been in business, right? Newer companies, older companies, and also whether you have capital or not. So a lot of times when people think about deals, they think about mergers and acquisitions. And that's certainly a type of deal that can be done. The distinction between a merger and an acquisition is really a legal distinction on structure. Acquisitions are the most common types of deals in this area. And acquisitions can be done two ways. One is an asset acquisition, and one is a equity acquisition, which could be an acquisition of stock in a corporation or membership interest or partnership interest in an LLC or a partnership. Now, we're not going to delve deeply into each of these, but I just want to give you an overview here. So it's really where one company acquires the other, either through assets or through equity purchase. A merger, on the other hand, a true merger is really a legal structure where two companies come together and form one company. There's often a surviving company between the two. So if I'm merging my company with your company, maybe your company will survive and mine will go away. Or sometimes you're merging two companies into yet a third company. But so a lot of times when you hear deals reported that they call a merger, they're really an acquisition. And when you hear acquisition, occasionally they're a merger, but much more often they're acquisitions. Now, even in a merger, unless it's really a merger of two equals, which is very, very rare, from a practical point of view, even though the legal structure is a merger, there's often somebody who's the dominant people whose executives are going to be continuing to really run the company and have the most influence. Those deals, although they're often done by bigger companies, and certainly ones that require significant capital, the bigger complex ones, are done by big companies. I've done plenty of merger and acquisition deals, and there's plenty of smaller companies that do them. They're just on a smaller scale. And some of those deals, by the way, can be done with capital up front, in whole or in part. But there are many deals where the payment's all over time, whether that's through a promissory note, some installment payment, or whether it's through what we call an earnout, which means that it's just a percentage of, it could be ongoing revenue or profits, or it could be the increase in ongoing revenues or profits. And earnout components are not unusual components of merger deals, even when there is cash, and acquisition deals, even when there's cash up front. But they could also be done as the entire part of the purchase price, the entire consideration. And you see those deals with smaller companies where there are no cash upfront deals that are being done. And you see them when there's certain strategic opportunities, and you certainly see them in down economies when maybe the targets are having a tough time and are looking to fold in. The other thing you see that's interesting, that's sometimes, in fact, very often sort of put out to the public and to the clients as a merger or an acquisition, is what some people refer to as acqui-hire. So really behind the scenes from a legal point of view, there is no merger or acquisition. You're really just hiring people. So let's say you have a group who would be strategically beneficial to your company, whether they provide you with geographic expansion or they provide you with certain skills to be able to grow into a new area, or maybe just in your core business, you need more talent. And you bring in the owner and some of the employees from an existing company, but you may not need to acquire them. You may just be able to hire them, especially if it's a situation where maybe that person realizes, the owner, the entrepreneur, that they're really good at what they do. They're a great computer programmer or accountant or architect or software designer, but they don't love running a business. Maybe they're not great at that, or they just don't like it. Certainly in down economies, this comes up a lot because, of course, up economies hide a lot of inefficiencies and sins, so that in down economies, people sometimes realize, hey, things are getting tougher. I got to make that payroll and I want to deal with that. So there's often times where there's an opportunity to hire people. You may position it out to the marketplace like it's an acquisition, but behind the scenes, all you've done is hired a bunch of people, maybe entered into employment contracts or not, and maybe put some sort of incentives in place based upon either growth or percentage of the revenue of the existing business that those people bring in that they get, and various ways that they participate either in the existing revenue or the upside, but it's structured as a hire. And there are so many deals that are done that way. And again, those are deals that can be done by companies of various sizes. Sometimes you hear the term tuck-in. Tuck-in is really a merger or acquisition normally, or it could be an acqui-hire, phrased as a tuck-in. But a tuck-in implies that you have a bigger entity tucking in or buying a smaller one. And by the way, that's much more related to the ratio. So it doesn't have to be a huge entity. You could be a relatively small company, but if it's a much smaller company that you're buying or bringing in, it's often referred to as a tuck-in. But don't confuse that, because really it's a merger or acquisition or an acqui-hire. Other types of deals, joint ventures. Sometimes, a lot of times you'll hear JV or joint ventures. Some people don't know what that means. There's fundamentally two types of joint ventures. One joint venture is a contractual joint venture, and the other type of joint venture is a company joint venture. So what's the difference between the two? Well, in a company joint venture, you literally would set up, let's say I have a company, you have a company. We're going to set up a third company, an actual entity, whether it's an LLC or corporation or whatever it is, that we're going to jointly own. So basically, it's a business partnership that is formed for the purposes of doing something that maybe our other two companies can do together, but we want to keep separate, and we don't want it to be run through one of our companies or the other. We want to create a new entity to do that we have joint ownership in, and maybe it's going to create its own enterprise value, and it's going to have some sort of relationship with each of our companies. So that is a corporate joint venture, a company joint venture, where we set up a new company and there's ownership. Then there's a contractual joint venture where really we're just entering into an agreement between my company and your company, company A and company B, for the purposes of coming together and doing something. So maybe I'm a manufacturer and you are a marketing company, or you're a distributor, and we want to get together. Now, we can just do that on a contractual basis where I'm paying you on a fee-for-service basis, right? There's a distribution contract or a marketing contract. But maybe you're just not the typical marketing company. Maybe you have some strategic relationships you can introduce me to that will get me more clients, or that will bring me key employees, or that maybe even will bring me some capital or other strategic partners. And so it's beyond that, and you want to benefit from that joint venture. So we may enter into a contract where it's not just fee for services, where it's much more of some sort of, let's say, revenue split or profit split, or some other arrangement where we're creating a joint venture. And by the way, in those situations,
We may even have a separate name for that venture, even though it would be a DBA, what we call a DBA, certificate of assumed name of one of our companies. But we're going to have separate branding on it, separate bank accounts potentially, et cetera. And we're going to do it contractually, and we're going to market it out as a separate division, at least, or vehicle that we both jointly benefit from, even though we're not doing it as a separate company. So that's joint ventures at a high level. There's also various types of, you hear joint marketing agreements, joint distribution agreements. I mentioned that before. Those are various forms of joint ventures. They're usually contractual arrangements that are done for those purposes. And what's interesting is a lot of companies don't take advantage of some of these things out there. Even with competitors. I mean, there are going to be examples on the show of people who, you think that what are they doing? They're doing deals with competitors, but it strategically makes sense for both sides. So that brings us to the concept of strategic alliance. We'll hear that a lot, doing strategic alliance deals. So from a definitional point of view, a strategic alliance from a legal structuring point of view is not anything separate. It's either a joint venture, or it could be whether it's contractual or through a company, or it could be some sort of other contract. But the concept is that we are entering into some sort of arrangement, an alliance that provides strategic benefit to both sides. So that's a strategic alliance. Again, it's really just another name for some of these other things. And it's a way that so many companies grow. There's a whole other category of deals that relate to raising capital, right? So again, a lot of people think, whoa, only certain high-tech growth companies, fast companies, growing companies that are going to go public or be acquired are going to raise capital. And certainly if you're talking about sophisticated venture capital money, that's probably the case, right? VCs are probably not going to invest in your local coffee shop unless you have a plan to have multiple locations and potentially franchise or have, a nationwide coffee chain. But there are also other types of investments. There's friends and family investments, which is literally what it sounds like. You're raising money from friends and family. And many companies raise money in that fashion and do it in exchange for equity or debt, because when you raise capital, you can either do some sort of debt, which is basically a loan, a debt instrument of some sort, or you can do it in exchange for some sort of equity. And when I say some sort of equity, it could be various classes of equity or types of equity in your either corporation or LLC or whatever type of entity you have. And that equity could have different rights. So we're going to be talking about some of those kind of deals on the show. Then there are angel investors, what they call angels. Who are angels? Angels range from people who are just wealthy people who sort of on the side invest, to people who are more quote unquote professional angels who are approaching more to be VCs. But the thing with venture capitalists is usually they're investing other people's money, whereas angels are most often investing their own money. So the deals are different with friends and family, with angels, with venture capitalists. And we'll be talking about those various types of deals. And they, again, apply to companies up and down the spectrum. Although, keep in mind, most companies are not going to be funded outside. The majority of companies are not outside funded, but there's certainly some opportunities to fund companies or fund aspects of what you do. And we'll talk about that as well on the show. One of the distinctions I want to make is you hear the word private equity firms. And even though they're sometimes used interchangeably with venture capitalists, the true definition of a private equity firm is a firm that actually acquires your entire company, or at least a majority controlling interest in your company. Whereas venture capitalists are really just investors who will initially often invest on a minority ownership basis with some protections and rights that they get. So we'll be talking about those kind of deals. What are other types of deals? Well, licensing. Licensing is a whole area that certain people make so much money on, and it's underutilized. Yes, you can license patents and inventions and that whole thing, which only applies to certain companies. And in a service business, so you're probably not going to be licensing, any kind of patents. But people license their content, right? I know people think they make most of their money like either writing books or giving speeches. Now we're going to have a couple of these people on the show. But really the biggest way they're making money that way, but the biggest way they're making money is through licensing. They're licensing their curriculum. They're licensing their content. They're licensing other people to train in their workshops. They're doing things online where they're providing licensing for online training. And the licensing business can be a great, great business. Listen, I don't want to get political here, but frankly, if you understand Donald Trump, people think Donald Trump is a developer or he's a businessman. And the truth is, if you look at most of his deals, he's a licensing company. He licenses his name to be put on stuff. And we can have an opinion of him one way or the other and how some of his deals have gone bad and not gone bad. The point is, though, that he's made his money mainly through licensing. There are other examples which may be more palatable to some people who also have done that as well. My point, though, is it's a great business. I'll tell you why. You can create a licensing company with not a lot of employees, right? You got to have something licensed. You have to have great content, right? But if you license a brand or license content, really you're entering into contracts for these things that you've created. It happens in the clothing industry all the time, right? There's a great example. All the designers, they're not sitting there manufacturing all of their own stuff. They may manufacture some stuff, have direct manufacturing agreements, but then they're licensing out their name for belts and ties and dresses and shoes and whatever. And you have certain contractual rights that protect you, that create certain standards, and basically you get royalty money. It could be a great business. And even if that's not your main business, you may have some things in your business that you can license, even on a smaller scale, to other companies. Then there's affiliate deals and referral arrangements. There is very simple referral arrangements where companies give a percentage if you send them a client. But then, especially in the online world, there are various types of affiliate deals. And often those deals are as much as 50-50 in terms of the split on the revenue. Why? Because you may be the person with the particular content, but the affiliate is somebody who has an audience, but they have a following that they can put you in front of. And they're the ones who bring you the business. And very often, there's a various range, but it's not unusual for those deals to be 50-50, these online affiliate deals. So that's an area that we'll be covering on the show as well, and you'll be learning about. Then there are also various types of all kinds of creative deals that don't necessarily fall into various categories. I mean, we're going to have somebody in the show who did a phenomenal deal basically with a bunch of companies that do the same thing that his company does around the country. And instead of having an informal referral arrangement, they created basically an industry association that we work with them on that really created a whole system and a joint effort to lift all those companies and have basically splits and referral arrangements, standing contracts back and forth. You'll hear about that. There are various, I remember I'm going to have this client on as well. We did a participation just many years ago where a client had raised some money through giving equity and didn't want to give more equity away. And they had a revenue stream from real estate agents that we basically gave people a piece of in exchange for their investment. So there are a lot of creative ways that you can do deals as well that we'll be talking about on the show. The other category that I want to mention is basically deals with your own employees. Now, some people don't think about those as deals because you hire them, you pay them, etc. But I have many clients and companies, and some of them are going to be on the show, that entrepreneurs that we work with and some we don't work with who will be on the show, where as opposed to choosing to sell their company, for example, they've just been less and less personally involved in the company, but it continues to throw off cash. And they say, why sell it? Well, in a lot of those situations, they're putting in place what I call attraction and retention vehicles for their employees. Things that make sure that key executives who are running the company and letting them be freed up stay around. And those things can include things like bonus plans and profit sharing, but also private phantom equity plans or phantom stock plans, equity appreciation rights or stock appreciation rights, SARs, option plans. So those various types of structures to maintain employees, I sort of put in the deal category as well, because they're deals with your employees. We're going to be talking about some of those on the show. We're also going to be talking about equity structuring of companies and profits interests and various types of classes of equity, because those are things that not only do investors get sometimes, but certain of your strategic partners maybe will take some of the equity to bind the relationship, and some of your employees may get various classes of those equity pieces to, again, keep them around, keep them incentivized. So we'll be talking about that. We'll also delve into real estate deals, not for the purposes of everybody being a real estate investor, although some of our listeners may be, but also there are various operating companies or other businesses who have secured their future by either buying their office situations or investing outside of their businesses to diversify, because so many of us have so much of our wealth concentrated in our own business who have got to diversify that into real estate, which may be related or unrelated to their core business. So we want to talk about that as well. We're going to have some people who do real estate deals on. So the message is that there are going to be so many types of deals that we'll be talking about. And trust me, there are a bunch of them that I haven't even touched on because there are various other types of deals that you can do. So what I really want to get across in this initial solo cast episode is just that the variety of types of deals. And then also in every one of those deals, there's different ways to approach them, to find people to do those deals with, to how you do diligence on it, how you do the due diligence on those deals, how you structure those deals, how you value those deals. And I don't want to bring all this up to say that it's so complex. There's some complexity in it, but with the right team in place, you can do it. And I just want to open up your minds as entrepreneurs and as executives to the various other ways that you can be doing deals to grow your business. And if you keep listening to the show, you'll get not only the information like this, but you will hear actual experiences and stories and people who've been through this and been there and done that. So if you have any questions on any of this, obviously reach out. I'm happy to answer them. Listen to the podcast. You'll get many answers on these things. We'll delve deeper into all these types of deals, and we want to help you grow your business. So I want to thank you all for listening. Thank you for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor, other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. So until next week.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. The Deal Den is a place where entrepreneurs, high-level executives, and business leaders come together, support each other's growth and success, and share what's working best, as well as what challenges we are facing right now. You will get input not only from me, but from all of our members. We collaborate and serve each other. To join us, go to corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.